Hey guys, so today I'll be teaching you a support resistance strategy that I have been practicing in backtesting for the past few months. It works very well. Support and resistance is not a very new concept, but of course with this strategy there are a few confluences that I have added which make the strategy more of high probability. There are also a few conditions that I look for which help me to clearly define what a good trading day or what a good trading week looks like. So I'll be sharing all of that in this video. I've done many videos on the supply and demand strategy which I still use on specific currency pairs. So this strategy will also be applicable for very specific pairs which I will share. This is my latest trade setup that I took yesterday with a very tight stop loss of about 15 pips and a take profit of 45. So it's more of an intraday setup. Literally within a few hours, you should be out of the market. And the advantage is that this strategy has the capacity to even have a very tighter stop loss. Though I was using a 15 pip stop loss because that's what I've backtested with. But even with a 10 pip stop loss, the strategy still works on some pairs. And the advantage of a small stop loss is that you can have a great risk to reward. So I'll get into it. This strategy is simply a trend trading strategy. So all the trades we are trying to take must be in respect to the trend. We are not in any way looking for reversals. To identify the trend, I start with the daily time frame because it is a higher time frame, so it can give us enough data for us to know where the overall market direction is heading. If you understand market structure, then you clearly know that a downtrend is a market that has lower highs and lower lows, and an uptrend is the opposite. That means we have higher highs and higher lows. Now in this market, clearly we have lower highs and lower lows. So this is a downtrend. If you're very new to trading and you're still struggling to interpret the structure of the market, this is the easiest way to know the trend. Look at your chart from left to right, then look at where the price on the left starts. So right now on the left, this is the top somewhere here. Then move to the right until where the current price is today. This is the line of the current price today. If you put it like that, automatically you can see the direction is going downwards. So even if you're not good at identifying the market structure, you can clearly know from a higher time frame where the market direction is heading by just using that concept. Being in a downward trend in this market of AUD CAD, the only types of trades I will be looking for is bearish trades. So I'm only looking to go short, nothing else. I'm not trying to buy. Now, without forgetting the context, I'm trying to give you a breakdown of yesterday's trade. So today is Thursday and yesterday was Wednesday. So the trade I'm trying to look for happened yesterday on Wednesday. So before you take a trade, the previous day candlestick must be in respect to the trend direction. That simply means if the trend is going downwards, the overall trend, for you to even think of taking a sell trade on that day, the previous day must be in support of the trend direction. That means the previous day candlestick must be bearish. Going to Wednesday's trade, the previous day from Wednesday, which was Tuesday, the candlestick was bearish in favor of the trend direction. That automatically qualifies Wednesday to be a trading day. Now, in the case the previous day candle closes opposite, I will not be even thinking of looking for a trade. A very good example is a day like this. This was on a Friday. So when Friday closes bullish, the whole trend is going down. So coming to Monday, even if I have the most perfect analysis and confirmation, I won't be thinking to sell because the previous day closed bullish. The reason why I came up with this analogy is because you'll just realize from a very simple analysis that most of the times whenever the previous day closed bullish, there is a very high chance the next day will also be bullish. And most of the time whenever the previous day closes bearish, there is a high chance we will have maybe a series of a few bearish days coming forward. I've not said it will happen all the time, but there is a high chance. That's why we do have many other confluences that I'll be showing you that we use for us to properly define a better trading day, apart from just taking the previous day's candle. That is not enough, because I know you can easily argue a day like this, the previous day was bearish, but the next day the market still went up. So I'll show you other confluences that I use. A simple example is one of the things is that I don't trade on Fridays. So if you look at this day, the market went up, right? That day was a Friday. If you can check the date down there, it was a Friday. So such confluences already help me to avoid being in the market on such specific days. So going back to the strategy, we've already determined that we'll be looking for a short position on Wednesday. Doesn't mean you must take a sell trade on Wednesday. It simply means that Wednesday is qualified as a good day to take a sell trade. Now, the next thing is you want to look for key levels of support and resistance. This is because those are the levels that we'll be using to get entries, but on the lower time frame. The entries will be on the lower time frame, but the support resistance levels are marked on the higher time frame. For those of you who don't understand support resistance, this is the whole basic idea. So support is simply any line somewhere below price, whereby price is above support. So whenever price comes to this specific level, it keeps bouncing off most of the time. It doesn't mean it has to bounce off forever, but most of the time it keeps on bouncing off. On the other hand, resistance is any line or zone somewhere above whereby price is below that line. And whenever price comes back somewhere to that line or zone, it keeps bouncing off to the downside. So if price is below, it's called resistance. If price is above it, it's called support. And support can turn to resistance. So that simply means the same line, whenever price is above it, we'll be calling it a support. So we'll be looking to buy above it. Whenever price is below it, we'll be calling it resistance. So we'll be looking to sell below this line, and the sequence continues. So when price goes above, it now becomes support. At support, we are looking to buy. It goes below, it becomes resistance. If it comes here, we are now looking to sell at the level. Now, don't go and apply this concept just independently like this. It will fail terribly. The idea of just buying at support and selling at resistance independently doesn't work very well. That's why we are going to combine other confluences. So now let's see how we are going to apply the support resistance levels on our chart. I'll just delete this for now. Going to where price was on Wednesday. The thing is, since we want to sell, we want to look for support resistance levels somewhere around where the current price is. I'm saying that because if you minimize your chart right now, you can identify support resistance levels all the way from up here, all the way from down here. But you see, it's not necessary for you to start marking 30 or 40 support resistance levels all the way from, let's say, somewhere up there, because price is very far from that level, and this is the daily time frame. For price to cover all that distance, currently it's about, let's say, 500 pips. It might take a whole 3-4 months, even a year to get up there. So we just want to focus on the levels that are around where the current price is, because we want to find a trade somewhere here, right? So we are only interested in the levels that are around where we are right now. For more practicality, on Wednesday, where the market was opening, or let's say where the price closed on Tuesday, since you're expecting to take a trade this next day, look at where the current price is, somewhere where it is. So just look for the 3 to 4 levels somewhere immediately, and 3 to 4 levels somewhere immediately above and below. These levels can never be precise. What that means is that sometimes it can end up being a zone or a straight line, but it's very hard for them to be precise. So for instance, right now here we have a level. The easiest way for you to know where the support resistance level is any area on your chart where you can see consistent wicks bouncing off there repeatedly. For example, if I come and zoom in a little bit, I want you to see this red candle. It came and bounced off there. That's the first wick. If you move somewhere forward, price was buying and buying. When it gets to this level, what happens? We get some wicks on that line and it bounces off. Same thing here, we have a green candlestick. Price comes here, we have a small bounce off. Same thing here, this green candlestick got rejected at that same level. If you move forward, you'll realize the same thing. The market is dropping, red candlestick comes to the same price level, bounces off upwards. We have another bounce off here, another bounce off there. Here we have another green candle, it comes there, it bounces off. Look at this long wick, got rejected at the same level. Look at this green wick, got rejected at the same level. Another wick, red wick, got rejected at the same level. If you've never drawn these levels on your chart, it will take some practice. But the easiest way that I always say is just look at your chart across from left to right. Try to minimize for you to have a better view, because when the chart is too big, you won't see the levels, because you want to see the chart with a wider view from left to right. Then look at any place that you can see consistent wicks repeatedly across that zone. Somewhere here, we also have another wick. So price was selling and selling. When it gets here, what happens? It bounces off. So you can see there are so many evidences that this is a key level of support resistance. So whenever price will be above this line, when it comes down to it, it will be support. So we'll be expecting the market to continue to go up. Whenever price is below this line, somewhere like here, if it bounces off it, we are expecting it to continue to go down. So now I'll move on to drawing other support resistance levels. So if I just check a little bit up, looking from left to right, there is a possibility of a zone somewhere there. Somewhere here, we have another level. You can see those rejections at the same level. Now let's mark some levels below. After here, I go to the 4-hour time frame to try and see if there is any possibility of an immediate zone that maybe I have ignored somewhere. So the zones can be marked using both the daily time frame and the 4-hour. According to my strategy, only those two time frames. I don't go below the 4-hour to mark the levels, because I don't think they'll carry more weight as compared to the ones on the higher time frame. From the 4-hour, maybe I can just add one level somewhere around here. Can see we have a few wicks there which bounce off. So that's enough. You don't need to mark so many levels. That's enough. As long as we have a few levels above and below the current market price. Now we're getting closer to our trade. The next step is that I will go to the 15-minute time frame. Now on the 15-minute time frame is where ideally I find my entries. That's why I'm able to use a stop loss of about 10 to 15 pips because the entries are very, very precise. I prefer starting my day trading day at about 6 a.m. So going to Wednesday, I'll mark where my 6 a.m. started and I'll show you exactly how I anticipated the trade. People often get confused and wonder, you have all these levels on your chart. So how do you know the one that's going to work? How do you know the one that will find an entry? It's very simple. You anticipate price to go back to the resistance. Then, depending on the confluences that you use, if the confluences come to play, you are going to sell at the resistance. So if price is below, you wait for it to go back, give you some confluence that you look for. Sometimes I look for an M pattern. If I get that, I'll be looking for a trade. The advantage of having confluences, you're just going to see it right now. It will simply save you from taking fake outs. So don't just think you can sell at resistance blindly. For me, unless a specific set of things happen, I cannot take a trade at a resistance. When the price comes back to resistance, anywhere from 6 a.m. because my trading day started, I do look for an M pattern as my first confluence. If you check carefully, price went all the way up. We had a drop. This green simply means it was buying. Then we had two red which went all the way below. So this is an M pattern. I've done many videos explaining that, so you can just check that back, especially in the supply and demand videos, because you do have different types of M patterns and it doesn't have to be perfect as long as the neckline is sandwiched in between the starting and the ending point. So the neckline cannot be below. As long as the neckline is somewhere in the middle of this and this, it is still a valid pattern. Once the M pattern is complete, I wait for price to retest the neckline. The neckline is the middle part of the pattern. So when price comes and retests the neckline, this is when I'll be taking the trade. However, before you take the trade, there is one more confluence that must come into play. When we find our M pattern, for instance, the M pattern closed at exactly 7:15 a.m. When we find the M pattern, we cannot take the trade unless the previous 1 hour candlestick was also bearish. So if the M pattern has closed at 7:15 a.m., we're going to go and check the previous candle. So if this is 7:15, the previous 1 hour candle is the one that opened between 6 and closed at 7. So we go all the way to the 1 hour. The candle between 6 to 7, we can already see yesterday was bearish. So that is it. So that means that was a valid entry yesterday. So now once we have the M, I wait for price to retest the neckline. And since the previous 1 hour was bearish, this is a valid entry. So when it retests the neckline, I'll come and take a sell trade here. That was about, what time is that? 7:30 a.m. Now this is what I've been telling you. This strategy can work with a very precise stop loss. Like you can see here, the market did not even go 3 pips. It actually went 4 pips above the opening price. So you could have easily done a 5 or 10 pip stop loss here. I don't necessarily preach 5 pip stop loss. I mean, if it works for you, that's fine. But for me, I still believe you want to give your trade some room. I mean, if you have the backtest at the end of the day and it works for you, you can't argue with data. However, if you also consider things like spread, the 3 pip stop loss doesn't work very, very well. So I would do anywhere from 10 to 15. If you did a 10 pip stop loss, this market already dropped all the way to over 25 pips. So you could have easily done a 1:2.5 risk to reward ratio here yesterday. If you do a 1:2, that means you are doing 20 pips. However, I have been trading using a 15 pip stop most of the time. So this is what I do. I put my stop at 15. I like to be a little bit conservative on my trades, give them room to play. If they fail, they fail. So I have been using a stop loss of 15 and a take profit of 45 pips. So it has been a 1:3 risk to reward ratio. Now you can already see the first trade yesterday did not necessarily hit our target. So this is where the break-even rule comes in. The break-even rule for this strategy is simple. Anytime the market goes to my direction with a minimum of 20 pips, I automatically adjust my stop loss to break even. So when it reversed here, I closed at 0. I made nothing on this trade. It's important that I show you this break-even trade because this strategy is not necessarily perfect. I don't want you to think that every trade will be going to your TP directly. Sometimes you'll be forced to take 2 to 3 trades in a day for you to find the perfect one. So after setup 1 has failed, we anticipate the same thing. If it goes back up, we anticipate to find an M somewhere there. And if the previous 1 hour candlestick is bearish, we take a trade. Now, I want you to see something. When price came back to this resistance, this was at about 12.15. I can clearly see an M pattern here because this green simply means it was buying, red it was selling, green it was buying, and red it was selling. So it gave us another M pattern somewhere here. Now the M pattern closes at what time? It closes at 1:15 p.m. if you check the time down there. The previous 1 hour must be bearish for it to confirm to us that we have some strength in this market. So since it's 1:15, the previous 1 hour is the one that opened between 12 to 1 p.m. So you go back to the 1 hour and look for 12 to 1 p.m. Now, if I remove everything and go back to Wednesday, 12 to 1 p.m., this is the candlestick. You can see 12 to 1 p.m. was completely bullish, which is opposite of the market direction. So now you see why having many confluences helps you to know which level to enter the market. So since the previous 1 hour was bullish, without a doubt, I am not even going to consider the entry on the 15-minute. So this entry was a fake out. For me, this was not a valid entry simply because even though we found our M pattern, the previous 1 hour was not in support. So I hope by now you are getting the concept of how you can have very many support resistance lines on your chart, but it doesn't mean that you'll be trying to sell at any of them because there's no guarantee that all of them will give all the confluences. So when price gets to any of this level, your work is just to check which level will have all the confluences ticking the boxes. So now let's look at the next level. Price moved to the next level. Here there was no pattern. It quickly broke because there is no complete M pattern here, so there's nothing to check. Now from that, look at the next level. The next level, we do have an M pattern, and I can show you very, very clearly. Once price hit here, if you track back, you can see this was buying. We had a big sell, big buy, and a big sell which closed below the neckline. So yes, we had an M pattern. As the 5 p.m. candlestick is going back to retest the neckline, because you can see this 5 p.m. candlestick is the one that went back to retest the neckline. So before we take the trade at the neckline, the question is, has the previous 1 hour closed bearish? The previous one was between 4 to 5. So let's go and check what happened between 4 to 5 p.m. Here it is between 4 to 5 p.m. If we remove the drawings, this is the candlestick between 4 to 5. You can see the 4 to 5 p.m. candlestick was extremely bearish, and it even closed with a long rejection of buyers, simply meaning it was buying so strongly, then the sellers rejected them. So we do have our confluences matching up, which means we have a valid trade. So you come and take your trade as it retests the neckline there. It retested somewhere here at 5 p.m. There it is, the stop loss level at 15 pips, profit level at 45 pips, a risk to reward ratio of 1:3. So you can come and check. A few minutes or hours later, the trade hit my target very, very well. This is a perfect example on how you can trade using support and resistance. I hope you followed the steps. Do let me know if you have any questions to this strategy, because I've not done many videos about it. This is the first. If you have any issues, just text them in the comment section, and I would probably do a part 2 doing more in-depth analysis, analyzing many different other pairs apart from this, and answering any questions that you have. I'll add more confluences that you must check. Number 1, we don't take trades during NFP week. Now, in a month, we do have about 4 trading weeks. Out of the 4 trading weeks, this strategy, according to me, it's only tradable 3 weeks. During NFP week, the markets usually tend to consolidate a lot as it heads to NFP, simply because all the big players in the market are anticipating to see how the news will come out, how the data will come out. Some are anticipating to be positive or negative. Because of all that confusion, NFP week, you hardly get the market stretching to even give you a 1:3 of, let's say, 50 pips, 45 pips. You just find the market going all the way to some 20 pips, going all the way back up. It goes 30 pips, it goes all the way back up. So for someone like me, I don't fancy such a market. The next thing, bank holidays. Whenever we have a bank holiday like today, which was Thursday, we don't take a trade. Now, this explains why, if I go to the daily time frame, question you can simply ask me is, yesterday was Wednesday, we took a trade and we hit TP. That is perfect. However, yesterday's candlestick closed bearish, right? That means today should be a good day to look for a bearish trend, because yesterday's candlestick is supporting the trend. So today being Thursday, the first thing you should be looking for is to sell AUD card. Now, one of the questions here is that, but the trade failed. However, this is where the confluences come in. Look at today. Today was Thursday. Today, what was there? We had a US holiday. Now, whenever we have US holiday, I do not trade any market. If you've traded long enough, you'd understand that US holidays usually affect almost all markets. Major economic activity in the US usually affects all markets, just like NFP. NFP is supposed to be for the US dollar, but look at all the markets during NFP. All markets react. Look at CPI. CPI for the dollar specifically. CPI for the dollar is supposed to be to affect the USD, but whenever we have CPI for USD, even a card is going to spike up and down. However, if we have CPI for, let's say, Australian dollar, it will only affect Australian dollar. If we have a PPI for Canadian dollar, it only affects Canadian dollar. But if the major news is for the US dollar, it affects every other market. So being a US holiday, I will not be taking any trade in the market today. Just by following the Confluence, you have avoided taking a loss. Otherwise, today you would be trying to take a short position at these levels, and I'm sure they probably even give you confirmations, but then they fail. So this is how I have developed this high probability system, by not only following the trend, by not only being precise with the entries, but also being very specific with certain confluences, which help me to increase the chances of knowing the difference between a good trading day and a bad trading day. Also, I don't take trades on Fridays as mentioned before. Then with other currency pairs, I don't take trades whenever we have major news that affect those specific pair. And I'm talking of high impact news. In this case, I'm talking of something like CPI, something like interest rate, and let's say PPI. That's it. I'm done with the strategy for today. This is how my watch list looks like for the support resistance pairs. This is what I trade all the way from Euro USD moving forward. I think these are about 10 pairs. These first two, of course, you can ignore them, but these are the pairs that I trade, about 10 of them. So the advantage of having many pairs is that when you analyze all of them, you'll always find maybe an entry out of just one or two. So having 10 pairs doesn't mean you trade everything, because I'm very precise with my confluences. So when I analyze all 10 pairs, sometimes only 2 of them play out in a whole week. Do let me know what you think of the strategy. If you have any questions, I will be answering them. See you in my next video.